This is the one I get all the time. When will mortgage rates go down?
Boy, it's such a good question. It is the $1 million question.
Hello, I'm William Smith with the Carmel Luxury Group at Coldwell Banker Realty, and we've got the pleasure of having Chad Hawker back on our podcast. I want to make sure that everybody knows who Chad Hawker is. He's our local representative for Synergy One Lending, but not only is he local, internationally, he is number one with Synergy One Lending for a lending volume, also lending expertise, and he has been a great friend and mentor for all of us at the Carmel Luxury Group. So I want to make sure that when you hear him speak, you listen because he's got a lot to say. So Chad, welcome back to the Carmel Luxury Group's podcast. Thank you very much for joining us.
William, thank you. It's always a pleasure to do this together.
All right. I came prepared this time. I went to Perplexity, typed in what are trending frequently asked questions for mortgage rates and loans. So these are pretty basic things that I wanted to make sure that we had for you. And then you can take it and run with it because these are the questions I'm getting every day from new buyers that are coming into the market. And some of the old buyers are saying, hey, William, what's going on with interest rates? First question, what are the current interest rates?
Sure. Yeah, I love the foundational questions because we tend to want to overcomplicate things and it doesn't need to be. So first, understand that what determines a rate for an individual, there's a lot of variables. There's credit score, there's the type of loan, there's the type of occupancy, there's the type of qualifying. There's just a lot of variables that go into interest rates. In general, 30-year fixed interest rates are hovering in the high sixes to low sevens currently on a 30-year fix. If you did a shorter term loan, like a 15-year fixed, you're going to be more into the mid to lower sixes, again, on a 15-year fix. So in general, that's where interest rates are hovering currently.
All right. Well, I get your report every week. So this changes every day. So what we're talking about here, and the date is Friday, May 23rd, 2025. That's going to be completely different next Friday and the Friday after and the Friday after. Tune in to Chad Hawker, and he's all over social media. He can keep you current with what's going on with current rates. But then that leads me to the next question. This is the one I get all the time. When will mortgage rates go down?
Boy, it's such a good question. It is the $1 million question. And there's no real easy, quick way to answer that question. We have for now 2-3 years been told by analysts that the prediction is rates will drop. And why that is just because of the analysis of the data. What moves interest rates really is the economy. When we look at the jobs market, if that's showing signs of weakness, that will tend to move interest rates lower. When we see inflation, which is coming down, we tend to see interest rates move. All of this is also very much tied to the Fed. So the Fed really is 19 members that control the price of money. Now, the Fed funds rate, which they move up and down, is not necessarily mortgage rates. The Fed funds rate is the overnight borrowing rate between banks. But what they choose to do has an indirect correlation of how mortgage rates move. What they say they're going to do indirectly affects the movement of mortgage rates. What truly guides mortgage rates is the 10-year Treasury and the mortgage-backed security markets. So as you see the 10-year Treasury go down, the bond market, you tend to see mortgage rates move down. So that's really what drives mortgage rates in a normal environment. However, even though we've seen inflation come down dramatically, closer to the Fed's target of 2%, even though we are seeing, if you really lift up the hood of the data and analyze a significant trend of weakening within the job market, even though we see a weakening of GDP, all of which would normally cause the Fed to start to lower their Fed funds rate, thus mortgage rates would move down. They haven't done that yet. They did cut twice last year, which we saw mortgage rates respond, but they are somewhat paralyzed by other things going on in the market currently. Tariffs is a big one. There's a lot of uncertainty as to what the implementation of the tariffs will do to inflation, to the overall economy. And that tends to, over the last 2 months, created a great deal of volatility within the markets. We've seen it within the stock market. We've seen it within the bond market. And that, in effect, has pushed interest rates higher in the short term, because it wasn't but 8 weeks ago, we saw interest rates move into the low sixes, and now they've elevated back up into the high sixes. Back to your question, what is the future projection of rates? If we look at just the data, the primary core data of inflation, the job market, the overall economy, hearing that we're headed or may already be in a recession, that would lend us to believe that interest rates are going to be moving downward, right? So I hold to the fact that in a short term, like those folks that are buying a home currently and closing within the next 30 days, I would encourage those people to lock in their rate. There's a lot of volatility right now. Rates have been moving higher in the short term. So I would lock in that interest rate over the course of an escrow of 20 to 30 days. Looking long term, I have a lot of clients looking forward to refinancing. I personally believe that the second half of the year, we can get past the fears of recession and, past the fears of the tariffs, realizing that even if there is an impact to inflation, it is a temporary impact. Inflation comes down, the job market weakens, and the GDP is of concern, then we are going to see these interest rates fall based on the data, right? So that is my perspective on short-term and long-term projection of interest rates.
Excellent advice. And one thing that I really like hearing what you're saying is that this is temporary. So you're sort of like being the airline pilot that's saying, okay, we're coming to a little bit of a rough patch. Better put your seatbelt on, but we're going to get there. Actually, we're going to get to New York a little bit earlier than we expected. So don't worry. But then everything we hear on the media is, oh my God, we're all going to die. I think that we got a short-term issue. Long-term, it could be just fine when things calm down. And what you just told us is that if you lock in now, that gives you an opportunity to have a lower rate in case we do have that short-term increase. But then toward the end of the year, maybe we refinance it. Do you think it'll get low enough to make it worth our while to refinance at the end of the year?
Yes, I loved your analogy. Yeah. Again, the data, if you stick to the data itself and move away from what the media does, which is 90% inaccurate, there's strong reason to think that you'll have a chance to refi, whether it's the end of this year or early next year. That is a very strong likelihood of happening. And that you bring up, not to get off subject, but the media is causing a great deal of paralysis for people buying, right? That they're waiting for something. They're waiting for rates to fall. They're waiting for this potential correction within real estate. And that's the fear created by the media. But that is not reality. We have a market that values are very much supported and in fact continue to rise. They've already risen approximately on pace for 3 to 4% this year. The projections from the National Association of Realtors was 4 to 5% this year. You have a subdued demand out there right now as we head into spring. There, if you look at the last several years, around this time, there was a little bit of a subdued demand. It's even more subdued this year just because of the fear that's out there around the new presidency and the tariffs and this and that. For me, this creates more opportunity because you have an uptick in inventory, still a great deal of demand, but subdued demand, to where if you act now, you can negotiate better with less demand. And then by getting into contract now, we can improve upon the interest rate later in the year, next year. But if things happen and demand rates fall, demand picks up, now you're looking at the same property you're gonna have to pay 3% more for it. So definitely an opportunity right now to get away from what the media is telling you. Look at just the data and realize that there is an opportunity right now to purchase a property.
Well, what I'm telling my sellers in strategies, make sure that you price yourself to be the most compelling price in your strata of the marketplace. And what I'm telling my buyers is now's a great time to do some negotiating for terms because there are some ways that you can get those interest rates down in the short term by doing some of your programs. And one of the ones I wanted to ask you about, because it's come up in a recent conversation with a buyer of mine, is the 2-1 buy down.
Yep.
And I bet you've got some sellers out there that would contribute to that. Can you explain how that works?
Yes, I can. And I have two buyers right now in contract utilizing the 2-1 buy down. So
Uh-huh.
the way the 2-1 buy down works, it's a standard 30-year fixed mortgage. All right.
Uh-huh.
Let's say the interest rate on that 30-year fixed mortgage is 6.75. All right. So what you do as part of negotiation is you negotiate a credit from the seller to buy down that interest rate 2% for the first year of their mortgage, 1% for the second year of that mortgage. And then after that second year, it just stays at 6.75. So let's explain that. Let's say you bought a property for $1 million, put 20% down. The interest rate, the loan amount is 800,000. The interest rate is actually 6.75. The seller provides an upfront credit in the amount, if I'm doing the math in my head correctly, the amount of $16,000. So they
All
give
right.
$1,000 to the seller. What this does for the buyer is in year one, they only have to pay an interest rate of 4.75.
Right.
This saves them on that mortgage over $1,000 a month for year one. Year two, it jumps up to 5.75, which is saving them about $500 a month for year two. And then in year three, it just stays at 6.75. So, what this does for a buyer is it provides them that payment relief of a much lower interest rate, right?
Uh-huh.
And then, if interest rates fall, that credit that they gave of $16,000 is only being used month by month. So if interest rates fall, say in 6 months, now they can take that credit. 6 months, they're using about $1,000 a month for the subsidy. They've only used about six of the 16,000. They can take that 10,000, refinance, pay for that refinance, and it works out brilliantly. It's a way
Wow.
that the buyer and the seller can work together to make a deal happen. And in order for that buyer to get the payment they need in a different way, they would need a much bigger drop in the price, right?
Uh-huh.
So that way the seller benefits because they're only having to give 16,000 versus a price reduction of say 50,000. And then
Right.
the buyer benefits because they have the lower payment.
And from what you were saying in our earlier conversation, is that if interest rates drop, and let's say they go into the mid fives, is
Yeah,
that a possibility in the next year?
very
So, but by doing the 2-1 buy down now, you're getting today's price, not the 3 to 6% appreciation price from a year from now.
exactly.
Plus, if
Yeah,
you're paying rent, you've just given away and you've paid a mortgage, but it wasn't yours, it was your landlord's.
exactly.
So this way it can be your mortgage, and then you can take advantage of the lower rate. If you could have a 5.25% or a 5.75% rate right now, you'd grab it. But if you get a 4.7, that would be unbelievable
Believable.
for a
You're working together with the, it benefits the seller, it benefits the buyer, avoids a big price reduction, so they both win. And then you can bridge the gap of having a lower rate to when these rates drop, and the seller ultimately is helping pay for that refi when that occurs. So it's a win-win across the board. And we can do this with just conforming loans, non-conforming loans. It's a great product that helps people take advantage of it in this market.
All right, so we will remember the 2-1 buy down and make sure that you call Chad Hawker at Synergy One Monday to get more information on that product that he has. Now
Yes.
I want to ask about another product because sometimes I have a seller that wants to buy something and they say, what do I do first? Do I sell my house first? But what if I don't find a house I like? And what if then I have nothing? I love the house I've been in for 30 years. I wanted to downsize, but I don't know if I can make that happen. And you told me a while back about a bridge loan product that you have that would be able to make it happen. And cash flow wise, it works well for the seller who's now becoming a buyer. Tell me a little bit more about your product that you call the bridge loan.
Yeah, boy, it is a product that has helped so many people make that transition, because the scenario is that, like you just presented, you have, and it works in a lot of different scenarios, but let's use the one of downsizing, like you said. So
Uh-huh.
someone owns a property, they've owned it for years, they have a ton of equity. Let's just say it's worth 2 million, it's free and clear. And they have another property that they want to buy. Let's say it's 1 million, right? So they have all this equity in their property, but they can't write an offer contingent on the sale of their property. So they have to write an offer before selling, knowing that their property will
Well, let me make a comment on that. If you make an offer contingent on the sale of your property, what you're saying to the seller of the property you want to buy is, I'll pay whatever you want. I don't even need a discount. I just want you to help me facilitate this. So will you wait 6 months while I get my house sold? And no, I can't guarantee that I'm going to sell it in 6 months. You're going to have to wait to find out. Now what the seller is saying, well, I'm not going to give you any discount because who knows if you're going to be able to execute. So then you're now vulnerable to having to pay maybe a high market rate or an above market rate just so that you could have your contingent sale done. So really what I'm looking for as real estate brokers, what is the solution? And Chad, what you're bringing up right now is a perfect solution for that scenario, because now what you're saying is that my seller can be a cash buyer now, and then they can move into their new house. We can get their house ready and just beautiful and staged and everything the way we want it to be market ready. And now we hit the market and we're not under a time crunch. So tell me a little bit more how the nuts and bolts of that bridge loan work.
How do I put this? It's very simple to understand, but it's the cost that we need to understand. So the way you qualify is purely on the equity in the combined properties. The 2 million you currently own, the 1 million you're going to buy. If you add that together, it's 3 million, right? So you essentially can finance up to 50% of the combined equity. So you don't need that in this case, because to buy the property, you only need 1 million. Right? You're buying 1 million.
Perfect. Yeah.
So basically you can finance 100% of the purchase price of the new one. That loan gets cross collateralized, attached to both properties. Right. There is no documentation required, which is different from a traditional. Wow. We have to provide income, run your credit, look at your assets. Because they're looking just at the equity in the property, you qualify in that manner alone. So that helps for folks that, say, are retired, they don't have a lot of income, right? And so they wouldn't qualify for a traditional mortgage anyway. So it allows them to qualify for 100% financing on the purchase through this bridge loan, right? They can close very quickly. There's no appraisals required. You can typically close in about 10 days. So now think about the value of this offer. Non-contingent offer, like an all cash, because there's no contingencies, close in 10 days. Now, instead of asking the seller to do something for you, the buyer is now saying, hey, I'm going to do something for you. I'm going to give you no contingent offer, 10-day close. I've seen it happen again. A lot of times they can get a really good deal on the property, say 10% off the list price.
Wow. Well, that pays for any cost that this loan would have for you above and beyond a normal mortgage.
Yeah. And then the costs are really quite simple. So whatever the amount is you're borrowing, the upfront cost is about 2%. So if you're borrowing $1 million, that's $20,000, which can be financed. And then the interest rate, because these are bridge loans, private loans, the interest rate will hover somewhere around 9.99 to 10.99. The initial reaction is, oh, that's high. Yeah, it is high. But remember, it's short term and there's no prepayment penalty on that. So a lot of times they'll make the purchase. The agent will get their current property on the market quickly. And sometimes we've seen those properties sell within a few weeks. So they're only paying that high interest rate for 3 weeks or however long it takes to sell the property, right? So even though it's a higher interest rate, it gets paid off very quickly. And then once it pays off, you sell the property, you pay the whole bridge loan off. Now you have a property that is free and clear. Anytime you have someone that has a lot of equity in their property, wants to write an offer, not contingent, be super competitive, there is no better way to do it than the bridge.
Well, that actually is music to my ears as a broker. And here's a solution that I can offer to my sellers who don't want to sell until they find a property that they want to buy, but they can't get the price they want because they have this weight on their shoulder of trying to get rid of the property and also trying to qualify for two loans and two payments. Now, which brings me another question. Market times are expanding. Now, what we were used to is 2 weeks to 2 months of property would normally be sold. And now a normal market time might be 1 month to 5 months, depending on where it is. That's still a seller's market because the benchmark that we've talked about in the past is maybe 6 months for market time before that starts tipping on a normal market. And remember, pre-pandemic, 6 months in the market was not unusual.
Right.
But we're starting to see these market times grow. But I don't want to necessarily have to make that payment if I'm this buyer who's also becoming a seller. Can I put those payments on the back of the loan, say for 6 months, so that I have time without having to make a payment? Because I am on a fixed income. I don't have any cash yet until I get my house sold. Now, once I get my house sold, in the scenario that we just used, I'll have $1 million in the bank. But I need to have some help with that cash flow. Can you offer some of that?
Yeah, that's the beauty of the bridge loan. Because it is private money, they can be very flexible on things like that. So again, you can finance 100% of the purchase price. You can finance the costs. And those costs will include the actual cost, title and escrow fees, your insurance for the first year, 6 months to up to 12 months of mortgage payments rolled to that loan. Again, it's all cost. So we have to figure out what that sweet spot is to be financially prudent, right? Yes, you can finance all of the payments up front through that type of mortgage. And you're right, for some people that are on a fixed income, that, they're not having to burn through any of their liquid money.
Wow.
It's fantastic.
You just explained two really great programs that you offer at Synergy One Lending that when I hear you say it, it just seems so simple. When I hear others talk about it, just seems like it's so difficult to grasp for some of my buyers and sellers who've never done this before. But thank you for that. And I'm going to use this video that we're creating from the vlog as a lesson on how to do this for the people that are asking those questions. So thank you for that.
My pleasure.
Last question I've got is, how much down payment do I need these days? And let's say that I'm looking at $1 million house, and let's say it's in Seaside. I'm unsure of, do I need 20%? Because that's a lot. Is there any way I can get by with less than that?
Yeah, that's maybe one of the most misunderstood or assumptions about buying a property is that I must have 20% down. It couldn't be further from the truth. The down payment is very much tied to the type of loan that we're looking to get. So a VA loan, if you are a veteran, we can finance up to 100% of the value of the property. And based on income analysis, you're unlimited to the size of the loan. If you have enough income, you could finance 100% of $3 million.
Wow.
No mortgage insurance.
That's amazing. VA loans have changed so much in the last 35 years that I've been a broker. That is amazing to hear.
No more loan limits. So the VA. Then we shift over to an FHA or conforming. There are loan limits in each county has a different loan limit. In Monterey County, it's 970. So up to 970 loan amount, you only have to put 3 to 3.5% down, depending on conforming or FHA. So you could buy $1 million property, put 30,000 down, and you would qualify. And then we still just need to analyze income credit for that qualifying. And then there's a mixture of different products. Like we did talk about the bridge loan, tech financing over 100% of the purchase because you're utilizing equity in multiple properties to do that, right? First-time home buyer, it tends to be more of like the conforming or the FHA or the VA type of products that really restrict the requirement of down payment and make it easier for folks to qualify.
I really appreciate you telling me this because this is going to be great for some of my first time home buyers. It's so hard for them to break into the market right now.
Sure is. Yeah.
And this is a big question that they have getting over that hurdle. And obviously, for some of our clients that are in the luxury market, we don't even talk about down payment, but you do have products for them that are favorable. And we do have luxury buyers that say, if I can get a cheap loan for my personal residence, I'd rather have my working capital work for me in the stock market or other investment property or turn it however I want to invest in my business. What kind of luxury loans for the upper end do you have? And how does that break down as far as down payments?
There's really no limit to the size of the loan that we can do. Typically, as you get higher and higher in loan amount, the down payment will get greater. Right. So if you're doing a $5 million loan, you're going to probably have to do 30% down.
Okay.
But quite frankly, someone that is capable of doing and qualifying per the income for a $5 million loan, you probably have 30% down.
What is interest rates on a 30 or a $5 million loan with 30%?
The same in the high sixes currently.
But if I were going to pay that, and if I can make more than 6% with my money, I'd gladly pay the 6% and have my $5 million to invest.
I have 2 clients right now doing jumbo loans. They could pay all cash.
Uh-huh.
Why would they pay all cash? Realize a loss because currently the stock market has been doing stuff, right? So let's not realize that loss. Let's finance it in the sixes. And then if they choose to pay it off in the future, they can. There's no prepayment penalty. So there's a lot more flexibility if they were to leverage themselves in finance. And they believe that they can get a bigger return than the high sixes over the course of the coming years.
Sure.
So a lot of reasons to finance versus just pay all cash. Rates, yes, they're higher. But historically, these are about average.
Oh, absolutely.
Average. Yeah.
When you and I got started together, there's no such thing as 3.5%, 4%. It was all 6, 7, 8% loan was not that unusual. But now we've gotten so spoiled with these low rates. But you know what? We're getting used to it. And I think if we can see something in the low sixes and high fives, I think this market is just going to break loose.
We saw last September, you can pull up whatever data you want. We saw rates dip into the high fives and everything went
boom
for 3 weeks, right? Yeah. And then it shot back up and then everything calmed down a little bit. So that was a perfect example of what will happen when these rates drop back down.
I'd much rather buy now when I have a lot of choices and sellers willing to do some of these negotiations with me than have to be in the frenzy when I'm competing against 16 offers for the house I want. I've run out of questions. Chad Hawker, you've done it again. You've answered everything that I had for this podcast. I'm looking forward for our next visit because who knows what's going to happen over the next 2 or 3 months, right?
Sure, for sure. I love being able to check in and help you and help your clients. So much of this is just proper education and accurate information anytime.
Okay, we're going to add below Chad Hawker's contact information. He's in Carmel, California, at Synergy One Lending. Chad Hawker, thank you very much. I'm William Smith with the Carmel Luxury Group at Coldwell Banker Realty in Carmel, California. We're looking forward to making sure that you get the best finance program available for the purchase that you make or the sale that you make. So, Chad, thank you very much again.
Thank you, William. Take care.
Bye.